Nike stock is down 20% after Q4 earnings, and it has a lot of people wondering, is it time to pull the trigger on this giant brand? Today I'm going to talk about that a little bit and see if it's worth an investment for the long term. So Nike's had a poor performance despite the dividend and buybacks. It's an iconic brand and offers a lot for investors in terms of the dividend and the buyback program. But is the price today, given all of its problems, appealing? And in my opinion, just the conclusion I'm going to give it to you up front, I think it's not that appealing. It's more of a hold. I'm not super interested yet. So the growth story for Nike is, we had flat full year revenue, 51.4 versus 51.2 last year. Fourth quarter revenue was actually down 2%, so basically flat. Gross margin was up 110 basis points, which is good, but you got to keep in mind this is a low EBIT margin business, around 13%, which you'd think it'd be a little bit higher, but they do have a lot of expenses, so it's not a very high margin business. Nike now expects fiscal year 2025 revenues to be down in the mid-single digits, with revenues in the first half of the year down in the high single digits. So Q1 revenues actually expect to be down 10%, reflecting muted wholesale order books and a softer outlook in China. And that softer outlook in China has been prominent in a lot of other companies like this as well. Just looking at the balance sheet, very clean, nothing worrying here. You have $11 billion in straight up cash, and you have $4.5 billion in account receivables and $7.5 billion in inventories. Historically, they've been able to get rid of their inventory pretty decently compared to a lot of other apparel, shoe type companies. So I'm not too worried there, considering their total current liabilities are only $10.5 billion and long-term debt's like $7 billion. So pretty clean book here. We can also clearly see that there's a lot of room for growth in Asia and Europe. If you look at the total net sales for North America, it's like 5.3 billion, but let's look at China, 1.8 billion. And I think there's just so much potential for Nike to really get in that market, start doing a lot of marketing, get influencers, and really take over a lot of the competition that's happening in places like China, Asia, in China's in Asia, but Europe and places like that, where I really think, potentially in the long term, they can have an even greater impact than their North American sales. If we look at a price to free cash flow, here I have the chart for market cap free cash flow, we can see it's actually very low. Right now around 24, and the mean is around, for market cap, at least free cash flow, price to cash flow is a little lower, it's in the low 30s. So, but I think it's for a good reason that it's so low. Price to free cash flow right now is like 22.5, I think, but growth is stagnated, and a lot of competitors, I'm going to show you a little bit later on running, they're doing great, double-digit revenue growth, they're getting they're profitable, so they need to really do something now to innovate, and it seems like if, growth stagnates for like another year and a half, 2 years, their free cash flow is probably going to be 5 to 6 billion, for a while, so I'm expecting 5 to 6 billion in free cash flow. Just looking at the debt maturities, I'll show you right here, but they have some notes due in 2030, 2040, $1 billion, 1.5 billion, 1 billion in 2027, 2025. They have another billion, but like I told you before, their free cash flow, if it stays constant, is going to be 5 to 6 billion a year, so no worries in terms of the debt payments. So pretty solid balance sheet, like I mentioned before. Another thing that's kind of worrying me, and it's kind of hindsight, is that they do buybacks. I'll talk a little bit about it later, but in June 2022, they approved an $18 billion buyback program, and you can see these share repurchases, given their future growth outlook, I think this price is much too high. Share price of 109, 104, 103, 116. We're talking price to free cash flow ratios of 30 to 35. But maybe at that time, the growth story was a lot better. So, it's hindsight really, but it's not great that they slowed down revenue growth and bought back a lot of their shares when it's expensive. So that's just something to keep in mind. Not particularly the best use of capital, but that's hindsight. Looking more in depth, just to go back to before, a 1.5% dividend is like $2.2 billion given their shares outstanding. In June 22, like I mentioned, the $18 billion buyback program, if you kind of average that out, even though it doesn't have to be averaged out, that's around $4.5 billion of buybacks every year. So the dividend plus the buyback would be over $6 billion in total. And remember, we said that the free cash flow was 5 to 6 billion, net of stock-based compensation, which isn't that bad. But growth is stagnating, so we're probably not going to get much more than 5 to 6, and it might even be lower. Who knows? So my speculation is that pretty soon they probably won't execute all of that buyback that they promised. And in my opinion, that's good, because I don't think the stock is as cheap as people think it is right now. At $76, I think it's not super cheap. It's just okay. I would rather they spend this money, free cash flow money, on growth. They really need to get some of those products, get in the other regions, increase their sales there. You know, they were talking about weak China outlook. They really need to start marketing there, hitting consumers, looking at their competitors who are growing double-digit revenues, and take out market share from those companies. So, like I said here, they need to spend money on growth. The stock really isn't that cheap if you consider the no growth aspect of things, even though the price to free cash flow is at, closer to historic lows. Just looking at some quick maths for just doing like a basic 2-second valuation. I mean, if the price to free cash flow stays around 22 to 23, it's at 22.5 right now, and free cash flow stagnates around $6 billion a few years out, that's a market cap of, around 132 billion or $87 a share if you exclude any like buyback or dividend. So, I mean, that's obviously just quick maths. We're not accounting for any other stock-based compensation or any debt repayment or anything like that, but that's really not that great of a return if you're just going off that simple math. And I don't really think I'm being conservative when I say 22 to 23 price to free cash flow ratio. I mean, it's low for Nike, which gets a premium because it's a quality company, but I mean, is it really going to be a quality company if it keeps stagnating in growth? And I think if it keeps stagnating, we're going to go sub 20 price to free cash flow pretty fast. So I really don't think it's as cheap as people think it is. If we just look at a competitor on running, which this is actually a stock that I own, they're growing double digits, and if you look at this image right here, they're growing CAGR like crazy in a lot of different markets. So, obviously a lot smaller companies, so you can't really compare them in the sense that obviously you're not going to get double-digit growth when a company is so large in any long-term aspect. But I think Nike needs to start looking at marketing products to get back to single-digit growth, or looking at acquiring some companies, maybe like On Running or other companies that really can, drive growth. So they need to use their free cash flow very wisely. My conclusion is really that, Nike probably isn't as cheap as you think it is, considering their growth is stagnant. If I had to buy the stock, it would be, probably $65, under 70, and I wouldn't mind starting a position. And even then, it would probably be, a 5 to 10 year hold, just because I don't think really anything exciting is going to happen in the next 2 years. I bet the stock, unless their next guidance gets upward or downward, I think the stock's going to be like range bound unless something happens. And in my opinion, they're probably going to need to stop buying back stock because the stock isn't that cheap, and if they're going to keep paying the dividend, they can't keep buying like $4 billion of stock every year given their free cash flow of like $5 to $6 billion. Plus they need to spend that money. Well, they don't need to, but I think they should spend that money on re-accelerating growth or increasing their EBIT margins, which are pretty low in my opinion for this type of company at like 13-14%. They should really market more to younger crowds in untapped markets like China, which you saw their sales comparatively were quite low, Europe and other regions like that. And like I said, I'm not like a big bull on Nike, but I'm not like a bear on it either. I just think it's more of like a hold, kind of wait and see what happens. And so I think, Nike could really be a great long-term investment. But until, we kind of see a bigger picture of what Nike is going to do to re-accelerate that growth or improve the margin, I don't really think this business is super interesting at the current price. If it goes down maybe like another 10%, I'll get a little more interested, and I wouldn't mind starting a position. But I think, in my opinion, at least, given the price to free cash flow, EV to free cash flow metric, and the growth and other things like that, the stock is not that cheap enough where the growth doesn't matter. If the stock was like $40, I mean, the growth doesn't matter because the stock price is so low that it's so far from the intrinsic value. Even if it doesn't grow, that it's a good buy. But I mean, we're not at that valuation yet, in my opinion. So for me, I'm just watching on the sideline. I think it's a hold for now, and I'm going to keep watching Nike and see what happens.